Marcus fixes refrigeration units for a living. On paper, he is fine. A van with his name on the side, a full calendar, a mortgage at a rate he will brag about for the rest of his life, 2 kids, a paycheck that lands on schedule. Drop him into a spreadsheet, and it shrugs. Employed, married, homeowner, stable. And by Friday afternoon, he is standing at a pawn shop counter, handing over the tools he needs Monday morning, because he came up $600 short for 9 days. I'm Nora. Today, I want to show you why money that looks completely normal can still be one ordinary Friday from breaking, and why, when the right dollars are not reachable in time, you do not get to set the price of the emergency. Somebody else does, and they are open late. Let me back up, because the how matters more than it looks. Marcus fixes the walk-in coolers and restaurant freezers, and the compressors humming behind every grocery store you have ever shopped in. Good work. Necessary work. The kind nobody thinks about until the milk starts going warm and someone is suddenly very glad his number is in their phone. On Monday, he looks better than fine. His wife works too. The paycheck lands on time. The spreadsheet has nothing bad to say about him. Then the week goes ordinary in the worst way. The water heater quits. No drama, no bang. It just stops, leaves a puddle on the basement floor, and turns the house into a negotiation nobody asked for. The friendly quote is $1,100 installed. Marcus can almost cover it. Almost. The mortgage cleared yesterday, the car payment clears tomorrow, and a big restaurant job he invoiced 3 weeks ago still has not paid because that owner is waiting on someone too. By Friday afternoon, Marcus is short about $600. Not short forever, not even short for the month, short for 9 days. So a man who fixes other people's equipment drives to a place where he can borrow against his own. The cordless tools, the diagnostic gauges, the things he needs Monday morning to earn the money that would have solved this whole problem if it had only arrived a little sooner. He hands them across the counter, takes the cash, signs the ticket, tries not to look too hard at the fee, and tells himself he will be back for them in 2 weeks. That is the episode. Not a crash, not a character flaw, a $600 gap on a Friday, and a perfectly normal household discovering that the word fine quietly depends on which day you ask. Now, here is the part I really want to build this whole episode on. When a household like Marcus's wants to know whether it is actually safe, it reaches for 2 numbers. One is the market. Is the economy up? Are things basically okay out there? The other is the average. Do I have roughly what a normal person my age is supposed to have? Almost everyone checks one or both. And both numbers are real, both of them sound reassuring, and both of them are quietly answering a question that has nothing to do with your Friday. So let me take them one at a time, because the entire trap lives in the gap between what those 2 numbers measure and what your week actually costs. Start with the market, the number that tells everyone things are fine. The week Marcus pawned his tools, the stock market was doing well, maybe near a record. And the companies that run pawn shops were doing well too. Not as a coincidence, as a business. Look at a chain like First Cash or Easy Corp. From across the street, they look like resellers of secondhand guitars and gold chains. That is not really where the money is. The money is in the loan book. First Cash has cleared $1 billion in revenue in a single quarter. With pawn loans on its books at a record somewhere around $850 million lent out against other people's stuff. When that number climbs, it does not mean more people are browsing. It means more people are standing exactly where Marcus stood, and the average loan is getting bigger. Not long ago, a typical pawn loan was around $160. Now it is closer to $240. The tickets are growing. Which usually means the things people are pawning are worth more, which usually means it is not just the desperate broke walking in anymore. It is the employed, the people with vans and mortgages. The cost of these loans is the part that should make you wince. Annualize the fees, and they can run from roughly 60% on the gentle end to well over 200% on the harsh end. Worse than almost any credit card. And here is the quiet engine underneath it. Most people get their stuff back. Redemption runs around 80 to 90%. Marcus does come back for his tools. That sounds like a happy ending until you notice what it actually means. The collateral comes home. The fees never do. The customer keeps returning, paying again, redeeming again. A loyal, repeating, paying customer whose loyalty is built entirely out of bad timing. Now follow the money one more step, because this is the part I cannot let go of. If you own a retirement fund, an index fund, a target date fund through your job, you might own a sliver of these companies, which means the very system that calls Marcus stable and employed and invested has quietly arranged it so that someone's future is earning a small return on Marcus's worst Friday. He is not just the borrower. He is the asset. I want to be careful here because the cheap version of this story is too easy. The cheap version says the market is fake. Everyone is broke, and the crash is coming any minute. I do not believe that. The market being up is real information. Plenty of households genuinely are fine. This is not a panic video. What I am pointing at is smaller and harder to see. Call it the desperation spread. One screen is measuring what big investors think companies might earn years from now. Another screen is measuring whether a working household can survive a broken water heater before Thursday's deposit. Both can be green at the same time. They are answering completely different questions. So when the first number, the market is up, gets used to quiet a worry that actually came from your checking account, you are taking reassurance from an instrument that was never built to measure your life. That is the first number, doing exactly what it does. It can be telling the truth about the economy and lying to you about your Friday in the same breath. So people reach for the second number to feel safe, the retirement average. Picture the other half of this story. Same night, a different house. Dishes done, kids asleep, laptop open at the kitchen table. Someone is looking at their retirement balance and feeling that small drop in the stomach. You know the one. They type the question almost everyone types. What does the average person my age actually have saved? They are hoping the number will tell them how scared to be. The number comes back. It should settle something. It doesn't, because the average is one of the most misleading comforts in personal finance. The headline figure for retirement savings lands somewhere around $334,000. Sounds reassuring, or terrifying, depending on your night. But the median, the actual middle household, half above and half below, is closer to $87,000. That is not a rounding difference. That is a different planet. Here is why the gap exists. Averages get yanked upward by the people at the very top. Put 9 families with $10,000 in a room, then walk in one family with $10 million. The average net worth in that room is now over $1 million. Nobody in the room is that person. Not the 9, not really even the 1, because their life is not the average either. The average just let the richest person in the room stand exactly where you are standing, and then asked why you do not measure up. It does not get friendlier closer to retirement. For households aged 55 to 64, the average balance is around $538,000. The median is around $185,000. And roughly 1 in 4 working-age Americans has nothing saved for retirement at all. 0. They are not in the average as a small number. They are in it as a whole. The top of the room quietly fills back in. Now, take that median balance and ask what it actually buys. Under the rule a lot of planners use, drawing down about 4% a year so the money lasts. A typical near-retirement nest egg throws off something like $660 a month. That is not a vacation fund. That is barely a phone bill, a tank of gas, and groceries with nothing left over. Which is exactly why for most households, Social Security is not the bonus on top. It is the support beam holding the whole structure up. And a support beam is not the same thing as proof you are safe. It is the thing standing between you and the floor. So when that person at the kitchen table asks, am I behind or am I normal? They are asking the wrong question. Am I average and am I safe are not the same sentence. You can be completely statistically ordinary and still be underbuilt for the life your money has to carry. The first number tells you whether the economy is up. The second number tells you whether a billionaire is in the room. Neither one tells you whether you are safe. Only your actual bills do that. And here is where the two numbers turn out to be the same number. Notice that this second story is just Marcus's Friday stretched across 40 years, short term. The gap says, I cannot cover this week. Long term, it says, I may not be able to cover the years after the paychecks stop. The pawn counter and the kitchen table are the same fragility on different clocks. Same question underneath both. When life finally asks for the money, on its day and not mine, is it actually reachable? So those are the two numbers, and neither one can see your Friday. Which raises the obvious objection. Fine, then just earn your way past it. Bigger paycheck, smaller gap. And sometimes that is true. More money genuinely helps. Of course it does. But the Friday gap has a habit of following people up the ladder because life is extremely good at absorbing a raise. The promotion comes. For a month, maybe two, it feels like relief, actual breathing room. Then it becomes the new normal. The nicer apartment starts to make sense. The newer car feels earned, and maybe it is. The kids' activities are not frivolous. The vacation is not absurd. Each subscription is small. None of it is stupid. And quietly, the old stress puts on better clothes and sits back down at the table. You earn more and keep the same thin strip. That is the trap that nobody warns you about. The distance between what comes in and what stays free does not automatically widen when your income rises. It just relocates to a higher number. A household pulling in $80,000 and a household pulling in $150,000 can feel the exact same airless panic on a bad Friday, because in both houses, the raise never became slack. It got assigned, subscribed, upgraded, and absorbed before any of it had the chance to turn into a cushion. That is the whole reason chasing more income by itself can fail you. It does not move you off either number. It just moves you to a more expensive version of the same gap. Earning more is useful. Protecting some of what arrives is the part almost everyone skips. If every new dollar already has a job before any of it becomes breathing room, then Friday still wins, just in a nicer kitchen. And this is the thing I most want you to hold on to. Fragility does not go away as your money grows. It just changes costume. At $600, it looks like a pawn ticket. At $600,000, it can look like a house you cannot tap, and a retirement account that charges you to rescue your own present. The bridge you need at one stage will not protect you at the next one. When you are starting from nothing, the trap is velocity. Early dollars have the most time to compound, so the real cost of delay is invisible and enormous. Every month you skip, every chunk that high-interest debt eats first, is growth you never get to replay. At that stage, the job is not to look sophisticated. It is to start, and to make it automatic enough to survive an ugly month. Once the account has some weight, the trap changes to concentration. Too much company stock. One rental property carrying the whole family's future. One bet that did well and quietly convinced you that you were smarter than luck. The danger is no longer emptiness. It is having too much riding on a single thing that can crack, and one crack erasing years. Then comes the costume that fools almost everyone because it looks like success. Call it phantom wealth or locked liquidity. A 7-figure net worth does not mean 7 figures you can actually touch. It can be sealed inside home equity, retirement accounts, a business, things that would hurt to sell in a hurry. The scoreboard counts every dollar. The reachable part is tiny. That is pawn shop fragility wearing a much nicer suit. The money exists somewhere. The net worth number looks fantastic, and it still cannot help you on a Friday when something breaks and the bill is due now. And the last one is the time trap, which arrives once the math finally works. The money is there, the freedom is technically possible, and the calendar and the identity stay stuck anyway. still trading days for a number that no longer needs growing, because nobody ever decided what enough was supposed to feel like. 4 costumes, 1 body underneath. Notice that the answer keeps changing shape. Early on, the bridge is a week of cash and a tiny automatic contribution. In the middle, it is spreading the bet, so 1 crack cannot sink you. Later, it is keeping enough reachable that a single emergency does not force a fire sale or a tax mess. That is not failure moving the goalposts. That is maintenance. You check the rules because your life keeps changing shape, and the thing that protected you last year can quietly become the thing exposing you this year. So what would I actually do? No panic, no lecture about your coffee. If the goal is to make a normal household meaningfully less breakable and to do it fast, I would start very small and very close. First, 1 week of expenses in cash you can reach today. Not invested, not optimized, not 3 transfers and a 2-day hold away. Reachable. That single layer would have rewritten Marcus's entire Friday. The water heater would still have been annoying. It just would not have owned his tools. And if the first version of that cushion is $20, then it is $20. Fine, start there. The point is not to look impressive. The point is to interrupt the loop before it gets expensive, because the expensive bridge always takes a bite out of next week, and next week is how fragility feeds itself. Then build that out to 1 month, wrapped around only the bills that keep the household standing. Housing, utilities, food, minimum payments, the gas to get to work. 1 week handles a mistimed draft. 1 month handles a slower mess, a late invoice, a real repair, a short gap between jobs, a stretch where everything just arrives in the wrong order. The practical trick is to separate that timing money from everything else before it dissolves into the fog of the checking account. Give it its own boring home. Name it something unglamorous, like bill buffer, not vacation. Not someday. When a little extra shows up, let a piece of it simply sit there for a full cycle instead of being handed straight to the loudest need in the house. Next, put a wall between your present emergency and your future money. Your retirement account is not your emergency fund. If you change jobs, roll the old one over properly instead of cashing it out. Cashing out is one of the most expensive bridges in existence because you pay the taxes, maybe a penalty. And you surrender growth, you will never get to replay. The cash cushion exists partly so that the future version of you stops being collateral for the present one. After that, automate the saving, because a standing transfer beats heroic willpower every time. The transfer does not care that you are tired. And if your job offers a match, take it. That is one of the only bridges where someone actually pays you to walk across. And as the assets grow, keep dragging them back toward that same test. Not all of it on one bet. Not all of it sealed behind a wall. Some real slice of what you own should be reachable without turning a single emergency into 3 new problems. A forced sale, a surprise tax bill, a hole punched in your retirement. The goal is not to keep everything liquid. It is to never be in a position where the only door out of a bad Friday is an expensive one. Underneath all of it is one plain question you can ask of every major dollar you own. If Friday got ugly, could I reach you? And what would it cost me to do it? That question is not glamorous. It is far more useful than a glossy net worth number because it is the only one that knows what day it is. The 2 numbers trained us to ask the wrong things. Is the market high? Am I average? Am I behind a crowd of people I will never meet, measured by numbers that were never built for my house? You can look at those numbers. I look at them too. Just do not let them be the thing that decides whether you are safe. The first one is measuring a future that might be profitable. The second one is measuring a crowd bent out of shape by the richest person in it. Neither one can see your Friday, so measure the Friday instead. If a $600 bill landed on the wrong day, would it push you onto an expensive bridge? And if so, what is the first small piece of cash you can move closer to yourself this week? If one bad week is survivable, but one slow month would flatten you, how many days are actually sitting in your buffer? If your emergency plan is secretly your retirement account, what can you stand in front of it so the future version of you stops being the collateral? If a raise came in last year and the fragile feeling never left, where did the new money actually go? And how much of the next one are you willing to leave unassigned long enough for it to become slack? And if you own real assets, but almost nothing you could touch without pain, which single dollar could you reach on a bad Friday? And what would it cost you to reach it? Ask it that way, not to feel behind, but to finally see the shape of the thing clearly. Because the fragile feeling is almost never a verdict on your character. It is a design problem. Money arrives just after life asks for it. Savings get counted in a way that does not match how you actually live. Assets look solid, right up until the moment you need them quickly. And design problems can be redesigned. Usually slowly, usually quietly, usually with boring choices nobody will ever applaud. The goal here was never to beat the average. The average cannot see you. The goal is to make sure the next bad Friday does not get to choose the terms of your life. Build that boring cushion close enough to touch and watch what happens to Marcus's week. The water heater becomes just a repair. The invoice becomes just late. The market can be whatever the market is. And the tools stay in the van, the savings stay saved, and the future stays in the future, where all of it belongs. I'm Nora. Make Friday boring. I'll see you next time.